It is important to measure the performance of a trading strategy over different periods of time. Here are some of the metrics that can be used to evaluate a trading strategy. Number of trades. This is important because if there are too few trades in a given period, all the other metrics may not be statistically significant to measure. Also, if there are too many trades, that may also give a generalized view that may not hold true in real trading environments. The ideal number is that which matches a realistic number of trades that one can hope to take in real trading, so it shouldn't be too low or too high. Win rate. This shows the percentage of trades that result in a positive return. Win rate is not a very useful metric in itself, but in combination with other factors, it can provide valuable information. Profit factor. This is one of the most important metrics to identify the edge of a trading strategy. It is calculated as the ratio of the average profit times the win rate to the average loss times the loss rate. If this number is greater than 1, then the strategy has an edge when traded consistently over a sizable number of trades. The larger this number, the better. A quick note here, the loss rate is 100% minus the win rate. Reward to risk ratio. This is similar to the profit factor. But while the profit factor gives the measure of the entire trades taken in a given strategy, the reward to risk ratio gives the edge of individual trades. It is calculated as the ratio of average profit to average loss. This too should be greater than 1, and the larger the better. Intuitively greater than 1 means that trades have a greater potential reward than the amount of risk taken. Expectancy. This measures if one can expect to make money over larger trades with the strategy. This is another way to look at the edge of the trading strategy. It is calculated as the difference between the average profit times the win rate and the average loss times the loss rate. For strategies that have an edge, the expectancy should be positive. The larger the value, the better. Value at risk at 95% level. This gives an idea of one of the commonly seen worst-case scenarios in any trade. In other words, it is a measure of a statistically relevant maximum that one can lose in a given trade of a strategy that is not by any random chance. It simply takes the bottom 5 percentile return value seen across all the backtests historically for the given time period.